Okay, so welcome back to my Vanguard Portfolio update now for the month of April all the way in 2023. I'm going to go through everything in my pension and my stocks and shares ISA. But just before we do that, as usual, let's have a little bit of a quick roundup of what's been going on in the stock market and the economy, both here in the UK and over in the US as well. And also, I have made some quite interesting changes in the portfolio that I did hint at last month's update. And I think many of you will be quite surprised and hopefully happy for me that I've simplified my life, but more on that one a bit later. Anyway, firstly, from a market perspective, if we head over to the US, we can see the S&P 500 has been on a little bit of a run over the past month. Although it's been trading steadily sideways over the past few days, we're now up 5% for the month. No doubt, as soon as I edit this video and put it on YouTube, everything will completely change, so just ignore all of the stats and things that you hear in this video. Now, in terms of big news events kind of driving things at the moment, there's still a lot of jitters around the banking crisis and everything that went on with those smaller regional banks over in the US. Everything that came from Silicon Valley Bank's very, very quick downfall and all the depositors rushing to take money out. Now, just over the past week or so, we did have the major banks in the US report their earnings to the markets. And actually, the big ones have done pretty well, as you can see here. For example, you've got the likes of JP Morgan, Bank of America, and Goldman Sachs all doing relatively well. Certainly JP Morgan's perspective, seeing their share price have a little bit of a nice little pop as they announce some big old profits, doing pretty well. And no doubt also seeing the benefit of people and businesses taking money out of those smaller banks and pumping them into the big boys, who fingers crossed shouldn't actually be going anywhere anytime soon. Aside from the banking crisis, many people did think that the US Federal Reserve, good old Jerome Powell and his friends, would actually keep interest rates steady. Instead, they chose to put them up 25 basis points, now sitting at 5%, as we said earlier. It'll be very interesting over the next few months and the rest of this year where interest rates lie. Those interest rates obviously have a huge influence on the way consumers spend their money. Everything from getting a mortgage to a car loan, some two big purchases that you can make in your life, and also increased rates for savers. So then there's a bit of a question about what you do at the moment. Do you put your money into the stock market working for you with the hope of a bigger increase? Or on the other hand, you go down the savings route. And actually over the last couple of days as well, even Apple, over in the US at least, announcing some very interesting savings products now above 4%. Making that extremely attractive compared to some of the years gone by. Anyway, leaving the US and just hopping back here over to the UK, let's have a quick look at how the FTSE 100 has done. I'll just pop this one on screen now for the last month. And as you'll see, it's also followed the US and gone up over 5% so far this month. Again, as soon as I film this video and edit it, no doubt that things will change. And then pretty much it's been trading sideways and things have been pretty boring in the UK market. Now, probably one of the biggest things going on in the UK economy at the moment is still dreaded inflation, but we will touch on that in a moment. But just before we head into that, I did see that report from the IMF that said the UK is trailing behind as an economy and going to decline 0.3% over 2023, only recovering to about 1% over in 2024. Now, I always take analysts' expectations and economists' projections with a bit of pinch of salt, but I do think it's quite interesting that the UK is lagging behind everyone else. Although an always important thing to note is that the economy and the stock market are two very different things, and the FTSE 100 is absolutely in no way really connected to the underlying economy of the UK, because the FTSE 100 sources so much of its profits and so much of its income from outside of the UK. So a better benchmark might be to use one of those benchmarks like the FTSE 250 if that's what you're more interested in, the health of the UK economy. There's still plenty of fear out there and talk whether we're actually going to get official recession, being 2 quarters of negative GDP growth in a row. Whether we get that or not, who knows, and how severe it will be, also who knows. Nothing in this world is certain, and everyone was projecting in 2022, saying how 2023 was going to be a guaranteed recession. We're definitely going to go down, and the stock market's definitely going to go down. Always interested seeing those people pop up in the comment section who are guaranteed to know what's going to happen to the stock market next week, next year, and also tell you how to invest your money. So I do tend to ignore those people. Now, as I mentioned earlier, inflation is probably one of the biggest issues at the moment here in the UK and over in the US, but definitely a lot more so here in the UK. If I just pull up one of my favorite sites to use here, Trueflation, who track inflation for us in quite a much more, I think probably more realistic way compared to what the numbers we get out from governments, you'll see that the US has steadily seen their inflation go down and down and down in a very good way, so clearly getting that under control. Whereas if we flip to the UK perspective, we're seeing that we've been very, very stubborn. And the latest results that came out from the UK government said we're above 10% inflation, being very, very stubborn there. But in reality, Trueflation has us around that 16% mark, as you can see on screen now. And what I like about the Trueflation data is I think that really reflects more of our experiences in real life in terms of what we see both when we go and do our food shopping, our energy bills, and no doubt as well when you go and fill the car up with fuel. Those are a bit more realistic compared to what the government says of just 10%. Anyway, we really need to be seeing those prices come down pretty soon, otherwise the Bank of England really only has that one lever to pull, and that is to increase those interest rates to reduce that demand on the economy, try and cool things down and reduce those levels of inflation. But who knows where we're going to end. It's going to be a very interesting year, that's for sure. I will say from my own experience with inflation, I'm going to be gutted when my 2-year energy tariff runs out. I got a fixed deal back in the summertime of 2021. Now we're in 2023. It's going to come to an end. I think my energy costs around the cap probably going to double, which is going to be pretty painful to swallow. Now, just quickly, one more bit of news before we do head live into the portfolio themselves. I did see a piece here from the Financial Times saying that the Bank of England is reviewing that £85,000 limit from the Financial Services Compensation Scheme that we currently are able to rely on. Because that hasn't been changed for a number of years, apparently, and I didn't realise this, about 2/3 of all accounts actually sit outside of that. Now, I imagine this is not really aimed at people like you and me, although I'm sure there are some of you out there who have large amounts of money in one place. But of course, if you imagine lots of business accounts sat with lots of money available, potentially they're ready to pay staff or invest in different equipment, that does put lots of deposits at risk if their institution were to fail. Now, just for comparison, over in the US, their accounts are protected $250,000 each, which is a much larger amount, of course, than £85,000. So be very interested to see what kind of balance we get. Also over in the US, they guarantee you'll get the money back in a lot of a quicker time period, just a couple of days, rather than up to a week with the UK at the moment. So some very interesting news there. Anyway, I'm sure we'd all welcome that. And while they're there, can they increase our ISA allowances too, at least by inflation every year? I think that'll be the minimum they can do. Right, I'll just log into my Vanguard account now and pull this all up for you. And rather than going through my pension and my ISA separately, I think this month and months moving forward, we may just do them together because I've made some big changes in the account and actually simplified a lots of my holdings. Now, as we'll go into my investments tab here, you'll see what I've done and what I've moved my account to. So in total for both accounts, we're now all into a single fund. So I've consolidated my 2 different holdings. For many regular viewers, you'll know that I used to be invested in VUSA, which is Vanguard's S&P 500 ETF, and their emerging markets ETF at about a kind of 85-90% split weighted toward the US. Now, as fun as that strategy is, one of the annoying things that I came across with Vanguard's platform is when you get paid those dividends, which you do from the likes of VUSA and those emerging markets funds, they do sit in your account unless you have that money enough to buy a whole share of an ETF. That money sits there, and that was kind of a little bit bugging me and annoying me. And I was like, you know what? On my Vanguard portfolio, at least, I wanted to keep things super simple and have something I can just set and forget and leave there. Because to be honest, I've got enough play in my Trading 212 account and my InvestEngine portfolio. Again, that's all shared on my channel. If you haven't seen that one, make sure you check that one out later. And I really wanted my Vanguard portfolio to be sat there, left alone. So as you can see, the fund I went for is the FTSE Global All Cap Index Fund, the accumulation version, meaning that all of my investments, all of my dividends will just keep rolling and snowballing and I won't have to touch a thing. And what I've managed to do as well is all of the little bits of cash that was in my portfolio across both my ISA and SIPP is get them invested into this mutual fund and everything is now good to go. Now, just for reference, if you haven't heard of the FTSE Global All Cap Index Fund, here it is on screen now from the Vanguard's website. Other brokers will have access to this fund too, but you'll need a kind of full service broker, probably one of the traditional ones like Hargreaves Lansdown, Interactive Investor, AJ Bell and the like, because this is a mutual fund and not an ETF. It does come in 2 different flavors. I've chosen the accumulation one, meaning that those dividends will get reinvested. If you are looking for income, you can just get it paid out as income and do what you want with that money, but I wanted to keep things nice and simple. As you can see here, one of the reasons I went for this is to just make my investing really, really simple because this is a global all cap index, meaning that it's pretty much going to cover everything from those smaller companies, medium companies, and those big, large ones and the mega caps in pretty much every market around the world. Now, as you can see at the moment, it's got over 7,000 companies inside of it with a pretty low ongoing cost. Yes, okay, it's not as cheap as VUSA at 0.07%. That's still really cheap in the long run at the end of the day. And also it's more of a peace of mind from my perspective, not have to worry. If you want to see what's inside any fund, you just go to the portfolio data tab here, which I'll open up. And you will see that anyway, in funds like this, most of your money is put to work in North America because that is the largest equity market in the world. And then dropping down from that, you'll see that some of your biggest other holdings will be in Europe and includes here in the UK as well, in the Pacific region, which includes Japan, and then emerging markets, of course, the likes of China and India. And then you do get a little bit from other markets too, but they really make up such a small fraction of your investing. And here we go. If you scroll down, you can see the different benchmarks and the different fund percentages that are actually weighted as you put money into your portfolio. Another benefit of the fund as well is it does give you a bit more diversification in terms of those exchange rates as well. Now, as UK investors, we are using pounds. And although most things around the world are traded in dollars, it is nice to not be fully reliant on the US dollar if you were invested fully in the US and have a bit more of a spread of your money. Anyway, that's the fund choice that I've made, but please do remember I'm not a professional financial advisor or any kind of qualified financial advisor in any way, so please do your own research and make sure you know what you're doing and be really, really careful with your own money. I've made plenty of very bad mistakes in the past, which I can't be asked sharing and going back through. But anyway, that's what the account looks like at the moment. Now, in terms of full performance perspective, you can see the account value is now at 54,158. Pension makes up a big part of that, and I consolidated different workplace pensions to make this happen at 42,615 and 70. Let's just dive into the ISA though anyway, just to see how things are looking. £11,542 and 35p. Now remember that this is an old ISA, which means I can't add any more money to it. I can technically transfer the ISA if I wanted to go to another provider, for example, but I can't add any more money to it. At the moment, I've chosen InvestEngine as my new portfolio for my ISA this tax year. So just remember that. I know it's very confusing and people can get very confused at that perspective. So I'm leaving this ISA with my SIPP to pretty much just sit there. I've got no intention of moving that one anywhere. And really this one's all about now is sitting back, relaxing, and letting this one compound over many, many, many years. But just for reference, we can still go back on the performance tab for the ISA, even though you've changed your different investments. It doesn't reset everything. And you can go back here over the long term. You can see my ISA, when I actually started it, when I made those contributions, and how the amounts have changed. And it's stayed relatively simple. The rate of return that it's given me is 5.12%. So it's been pretty steady, but not a huge amount has happened over those past couple of years, as you might expect in the stock market, and it's been well diversified and not in a few crazy hype growth stocks. Going back month by month, you can see 2023 has been not too bad so far from a growth perspective in terms of seeing those green returns. As always, like I say to many people, I'm not really bothered about the monthly changes in the stock market, and the more time you invest, at least for me, my perspective, the less I'm interested in those daily swings and different changes in the stock market over those many months. But it's still good to go back and kind of reinforce and check yourself. And also remember if you put different money in and how much things cost you in terms of fees, which you can always keep here. And a reminder to keep those fees really, really low for your investing career over that long, long period of time. And finally, just a quick look into the pension account. This was one which came in as a lump sum, as we can see here on the performance chart. And it's pretty much been ticking along nicely. I think its high point was back in the summer of 2022 when it hit about 45,000. And it's now at kind of 42, so just a couple of percent down on that one overall. But again, it's a long-term investment. Won't be able to touch this one for a couple of decades. So again, it's all about making this one simple and having this one work for me. And I really didn't want to see that cash sat in the account doing nothing. So now my entire portfolio, and I'll just get this one up again for you now, is really, really nice and simple with one fund. Hallelujah. I've kept things really, really simple. Anyway, that's the portfolio. How simple is that? Just one fund. No cash in the account, no messing around. I still get to play around and tinker in my Trading 212 account and my InvestEngine account, where I can be a little bit more picky and play around and tweak things. So that's kind of part of my nature. I've just accepted that. I am a tinkerer. This is what I do. Okay. But for other accounts, I want to try and keep things as simple as possible. This is my set and forget portfolio. Anyway, I'd love to know what your thoughts are on the portfolio now. Please let me know what you're investing in your Vanguard accounts. And also, what I'll do is I'll leave you with that video, if you haven't seen it already, of when I started my new InvestEngine portfolio, where I invested in different ETFs. And don't forget that you can join me on that platform too. Anyway, I'll leave you with that video. Thank you so much for watching to the end. And as always, happy investing.